Hello, good evening, everybody. Welcome to our third installment of Bursa I investing series. Uh, Today we're going to talk about how to build passive income at peak. All right. Although today we talk about Shariah-compliant stocks, Shariah-compliant investment, but basically, if you are into investing, you can actually learn some of the things that we're going to share with you today, right? How to actually build passive income. And of course, today is just um, you know, an overview, right? To give you an idea of how you can build a passive income. Then, of course, it's up to you then to prefer to actually build your own portfolio, right? So I'm just going to share with you some of the techniques and also some of the ideas and tools that is already around, but we just want to test it and try and see whether it works or not. All right. So again, I think I have the wrong sound. You guys can hear me? Oh, okay. Yeah, yeah, you can check it out. Okay, guys, can you hear me now? Is it better? Hold on. All right. Good. Okay. If it's clear, you can just say yes. All right. Thank you, 𝐿𝐿𝐴𝐻𝐿. Thank you, voice. Thank you guys for highlighting this. I do not know why I have to always plug in again my audio to get a better audio. All right. Okay, so yeah, basically I just mentioned today we're gonna talk about how to build passive income, right? How many of you actually want to build a passive income? Yep. And of course, today event is brought to you by Bursa Malaysia-𝑖, and we're gonna talk about Sharia compliance investments, right? But nevertheless, the techniques or the ideas I'm going to share with you is basically applicable for all. But if you are someone who is Sharia compliant, then you may want to take a look at the compliancy itself, right? And basically, more than 70% of stocks in Bursa Malaysia are already Sharia compliant, right? So, you're probably buying a Sharia compliant stock as well. Okay, now let me just, while we're waiting for others to drop in. Now, I'm going to share with you in a short while where you can get the slides for last week. All right. So remember, I told you this is actually a series of webinars by Bursa Malaysia-𝑖. It's going to be 7 weeks. So we are on the 3rd week right now. We have another 4 more coming in. All right. Yes, Daniel, I did not forget the list. Don't worry. I'll just share with you later on, right? Just in a short while. And that list is very important also on how we want to basically apply what I want to share today. All right. Okay, let me just share my screen. Welcome everybody. Welcome. Well, once again, I want to thank Bursa Malaysia-𝑖 for giving us the opportunity to to be part of their Bursa-𝑖 investment education series. Right, they actually have a set of a lot of other investment seminars and webinars going on as well. Right, and what we're basically they entask us to share with especially those who are non-Muslims, all right, what Sharia investing is all about, all right, and it is not that it's just for Muslims, right? It's actually for everyone as well. And if you are into ethical investing, later I'm going to share with you why actually Sharia is ethical, right? Because of its requirements to be Sharia compliant, all right.
This is your first time login, 𝐿𝐤𝐺𝐠. Is this on every Wednesday? Yes, every Wednesday we have a series of webinars by Bursa Malaysia-𝑖. So this is the third one. All right. And if you come to our Equity Tracker Facebook, we have actually every single night at 8 p.m. we have something on. It could be some other topics. All right. So you can just check out on our Facebook, and please do like our Facebook if you are first time here. All right. Okay, so I'm just going to share my screen. I hope you guys are ready. It may be a little bit heavy today, okay, but actually it's not really that heavy. The idea is simple, but the homework is a lot, lah. All right, if you really want to build a an investment portfolio where you generate passive income. All right, so we're going to talk about building passive income, and so what do we mean by passive income, right? So along the way we'll try to have some fun as well, lah. Okay, now before we start, as usual, whatever is being shared here today is for, or even discussed here today, is for informational and educational purposes only. It is not intended as any investment advice. All right. So this is an investment education series. So this is all about educating you guys to be a well-informed investor. All right. Okay, so let's start. Now, what is passive income, right? Now, of course, at the end of the day, we all want to, we want to get income without doing anything, lah. Okay, so basically, that's what passive income is all about, isn't it? It's basically derived from investments in any investment asset classes, right? Any investment asset classes that you can find, right? Or businesses or any activities that involves investing where you get returns, right? And which that person is not actively involved in managing that investment asset class. All right, so that means without doing anything, of course before that you need to do your homework first lah. But once you start to invest, then we basically just not, we don't want to be actively involved. We do not want to continue trading, but just leave the investment there and let the investment grow itself, right? But of course it looks easy, right? So basically building a passive income is like building a money tree, right? Planting a money tree. But the most difficult part is the planting part, right? And a lot of people give up along the way, yeah, because it's going to take a long time and a lot of passion for you to actually grow that tree. Okay, but once it's grown, once the tree has grown, then you are able to reap its fruits. All right, so the challenge is always to build that money tree. And for those who are still young, you guys have the best asset, which is time, right? And you can build your money tree easily. But if you're already 50s, 60s, it doesn't mean that you don't have time, but you can still build your money tree if you want to. All right, so that's what we want to do, how to build a money tree. Now there are many ways we can invest, right? Okay, now you look at a lot of things that we buy and we exchange our money with something. We are buying assets, right? So now out of all these pictures that you see here, maybe you can just type in your comment if you want to. Like I said, I try to make this as interactive as possible. Which one do you think is not an asset? All right, which one? Or all of them are assets? You just type in the comment if you can. Okay, so for example, cars, okay, yeah, or motorbikes or aeroplanes or helicopters. Real estate can be any property lah, right? Or even land. Okay, it can be residential, it can be commercial. All right, business, of course, is business an asset, right? Business that you own, a business that you invest in. What about commodities? What about unit trusts, mutual funds, money markets, bonds, and so on and so forth? Are these all assets? Yes or no? Okay, so which one is not an asset? Maybe if you can just type in the comment. Okay, the sports car. Cars. Okay, a lot of you will probably say car is not an asset, isn't it? Right? Well, I guess how you see an asset, right? Asset is actually a commodity where it has some value. Okay, but problem is some assets depreciate in value, some asset appreciates in value. For example, cars, right? We may think that it may not be an asset, but there are some vintage cars that are selling much more higher price than that it used to be, right? Because of its vintage status, right? Of course, selective cars lah. Okay, but clearly, transportation is most of the time is an asset, really, because you own it after, of course, paying the bank. But it is a depreciating asset, right? And all assets can depreciate or appreciate. Okay, for example, business can also depreciate or business can also appreciate, depends on how it's run, right? Even cash can appreciate or depreciate, right? Stocks, of course, unit trust, or even collectibles like arts, antiques, and so on and so forth. Some of them appreciate, some of them depreciate. Okay, so now, so whatever we own are basically assets, right? Now the question is, remember, what is passive income, right? Okay, now passive income, that particular asset that you invest in has to be income generating. So there's this term called income generating assets. Okay, now do you guys want to know what is basically income generating assets or not? For example, is gold, now we know gold is an asset and gold can appreciate and also depreciate in price, right? But is gold income generating? Yeah, is income generating? Is gold income generating? Okay, another question. Even cash is also an asset, right? But is cash income generating? Okay, so out of all the assets that you see there, right, which one do you think is income generating? Okay, I'm just going to put back the slides here. Which one do you think is income generating? That means without, you just put an investment there. Doesn't matter whether the price go, no, the asset can appreciate or depreciate, right? But that particular asset can also provide income. Okay. Yeah. So gold is not, right, because gold don't bear small goals or baby gold, right? Once you buy a gold, that's it. It sticks there. But of course, the price will fluctuate and will appreciate and also depreciate. Cars, of course, is not income generating, right? Okay, but if you are a Uber driver, cars can be income generating. So car can be asset to some people, right? But the thing is that we will not consider it as a income generating asset because if you don't drive, you don't generate any income from it, from the car itself, right? Okay, real estate, of course, is income generating because you can get rents if you rent it out, if you are able to rent it out, right? So that means you buy a property and you don't do anything and you just rent it out, and people just keep on paying rental to you. And of course, the rental can be, whether it's you have positive cash flow or negative cash flow depending on the mortgage that you pay. All right. Business is also income generating. Why? Because you can actually be a boss of a business. You invest but to build the business, it will take some time, a lot of effort to build that business, right? But once it's being able to run itself, then it's income generating. Yeah. Commodities, not stocks, you get dividends, right? Of course, unit trust, mutual funds, and other investment plans, right? They are all income generating assets. Okay, bonds, fixed deposits, they're all also income generating. Collectibles are not, right? Yeah, collectible is not. That's correct. Okay, yeah, Wenki. So it's basically when you invest, in an asset, and if that asset, it doesn't matter whether the price goes up or goes down, it still generates some income. All right, that's income generating asset. Okay. So real estate, and the two most common ones that most of us know about is basically real estate and stocks lah, right? Now, when we talk about income generating asset, I always remember this story. It's not really a story. This is what really happened, right? When I had a friend of mine, we did talks in universities before. So this is what he normally asks the students, right? Basically, it's a very hard question, especially if that someone is next to you. Okay, so you know what the question is basically this, right? Is your boyfriend, because they are still in universities lah, so boyfriend lah. I don't want to say husband and wife lah, more sensitive lah, right? So is your boyfriend or girlfriend an asset or liability? What do you guys think? Okay, Winky, you just asked, right? Is wife an asset? I don't talk about wife lah. Wife is a little bit sensitive lah, right? But girlfriend or boyfriend? Okay, what do you guys think? Asset or liability? Because opposite of asset is a liability lah, right? So is a girlfriend or boyfriend is an asset or liability? So imagine you get this question, all right? If we are physical, right? And your boyfriend or your girlfriend is next to you, and then suddenly the speaker go and point you and says, "What do you think?" Okay, this is what exactly happened. Okay. Rebecca Tang, boyfriend liability, girlfriend asset. Depends, liability, Ayo. I hope your girlfriend and boyfriends are not watching this, man. Yeah, so that one is that one. I think that one is both lah, right? Both asset and liability. And you know what? That guy who's being picked to answer, right? And the girlfriend was just next to him, next to her. So the guy says, my girlfriend. So he was panicked, right? He don't know what to do. So he just said, I think it's a depreciating asset lah. Okay, depreciating asset. Well, it's up to you lah. But basically, for me, not because my wife is here, but I think you guys should treat your other half as an asset, lah, right? That's why you call it the other half. Because without the other half, you won't be able to function. All right. Yeah. So basically, we need to know the income generated assets, because if you want to build passive income, right? If you want to build passive income, you have to invest something that is income generating, right? I can't invest in, let's say, gold. Okay, gold can go up and go down over the years, but gold does not generate income, okay, throughout the years. But I can invest in stocks, I can invest in real estates, I can invest in unit trusts, and so on and so forth. Okay, so there are quite a number of passive income, right? That there are quite a number of assets that you can actually invest in to get passive income. But why equities, right? And of course, equities is the asset class that makes the most returns over time. Okay, this is actually a graph shown here by Jeremy Siegel. This is from his book Stocks for the Long Run, right? So if you look at this, stocks has always been the main income generating asset, or the main asset that appreciates over time, right? Bonds come in second, then gold is down there. Even US home prices are not able to catch up the performance of stocks. Okay, and talking about a very long time frame, the chart that you see here, although it's like very short, but it's from 1890, right? So that's about more than 100 years. Okay, so over time, of course, stocks still perform the best, and that's the reason why a lot of investors always look at stocks as one of the main options to grow their wealth. All right. And of course, most of the rich or those who are well-to-do have somehow stocks in their portfolio, because that's how they actually grow their wealth as well. Okay, you can put in other asset classes, right? But of course, other asset classes will not grow as much as stocks or equities. Okay, but of course, with high growth also comes with higher risk. For example, if you just compare with putting money in stocks and putting your money in fixed deposits, right? So of course, fixed deposits, you get very low returns. Or you buy government bonds, for example, they're very low returns, but it's steady, right? It does not fluctuate like crazy, and you probably will get back your money, right? But stocks, it depends, right? You buy into a wrong business, and that's it, all your capital can go down. Okay, but if you buy in the right company with the right business, then your shares can appreciate further. So that's why we need that skill to know how to invest in the stock market. Okay. That guy slept outside, Daniel. You say, no, I mean, they are just boyfriend and girlfriend, so I don't know what happened after that. Okay, so so we are in the topic of stock investment, right? So that's the reason why we are all into stock investments, because it's one way for us to continue to preserve, okay, and also grow your capital or your investments. All right. So in stocks, there are two ways to generate income, all right, or profits. Okay, first is capital appreciation. That means you buy a stock which is 1 ringgit, and maybe 1 or 2 years later or 5 years later, it goes to 2 ringgit, and you sell at 2 ringgit, you make 100% gain. All right. So that's a capital gain. All right. Or it can be a capital loss if you sell it at lower price later. Okay. And then the other part of stocks is dividends, right? Because you have to remember that actually when you buy a company share or a stock, you are actually a shareholder or a business owner of a company. All right. I want to say business owner like, because you don't run the business, but you are actually a shareholder, right? You are part of that business. Okay, so it's actually in that business category. So the good thing about stocks is because although you invest in that business, you don't run the business. You have other people to run the business. If you start your own business, then you have to run it. So it is not if not, it is not passive anymore, right? If you start a business and you run it, it becomes more active. Okay. Or until one day when the company is good, big enough, you have enough staff and you can get out just being a shareholder and people run it for you. That's another story, right? But you can immediately become an owner of a company without being active by buying stocks. All right. So remember there are two. Okay. So I really this one I've already talked about last week, right? So if you miss this, you have to look at the recording last week, right? Because last week we actually had a recording on this topic about how to identify investment stocks, okay, which are Sharia compliant, of course. Okay. And so you really need to, I'm not going to go through the whole thing today again, because that will tell you basically whether this company are strong, right? Because we are talking about here, we are talking about companies that has 10 years of continuous net profits, 10 years of continuous dividends. That means every year they pay you dividends. Okay, and 10 years of operating cash flow, or positive operating cash flow. Cash flow is important for survival, right? And remember, because we want to invest and build a passive income portfolio, dividends are important, right? Because remember, I told you, dividends are the one that generates that income for you. Okay, whether the price go up or go down, if the company can pay dividend, then it's fantastic, right? So the reason why we do this list is this, because we want to make sure that number one, the company continues to pay dividend consistently. All right. Why we put operating cash flow is also important, because we need to know whether that company has enough cash or not, right? To sustain the business. Because if they don't enough cash, they may not be able to pay dividends as well. All right. So the first one, net profits, of course, that's the first criteria that you must have first, lah, right? Before they can even pay you dividends. Okay. So this particular list here, right? If you take these three criteria, 10 years of continuous profits, 10 years of continuous dividends, and 10 years of continuous positive cash flow. Continuous means every year without fail. Okay, it's not that 1 year they pay, 1 year they don't pay. No, every single year for the past 10 years they pay. Okay, so there are 123 out of 932 companies, okay, that meet this criteria. Okay, so the reason why we have this is because we want to, once we have a company that is consistent, so at least this company is likely going to be consistent in the future as well. Okay, as compared to companies that don't pay continuous dividend. They do pay dividends, but maybe some year they pay, some year they don't pay. Okay, so if they have that pattern, then it's very hard to see it's very hard to predict whether they're going to pay dividends or not, right? But if you have companies that have been paying dividends for the past 10 years, or in fact, there are some companies that has been paying dividends for the last 20 years without fail, all right? So if they have been paying like 10 years without fail or 20 years without fail, then definitely this company can sustain. Okay, especially, I mean, of course, you have to look at their financials as well, whether they can still sustain or not. Okay, but most likely they are able to, and they can be able to continue to pay dividends. All right. So I promise you this list, right? So now this is an example that, so I'm going to pick basically one stock to do as an example today. All right. Okay, so these are we already run this the last week, so I'm not going to go through this. Okay, now this is where you can download the link. Okay, you can download the slides for last week. Okay, not the slides you probably have, but this is to download that list, the 123 companies. Okay, so what I'm gonna do is I'm gonna just type it in here. Sorry, so that you are able to, if you can't see this, okay, I'll just type it in. Okay. All right. So I hope you're able to see it. Okay. So I'm only gonna put this up until midnight tonight. So you have to download by today, because after this, that file will not be there anymore. That link will not be working anymore. All right. So just click on the link, or just go to this link here. It's bit.ly or bit.ly / Shariah investment 1. Okay. You can download now if you want to. All right. So let me go on. Now we're gonna start with the simplest form of investment plan, right? Everybody, there are a few times when you guys asking about whether dollar cost averaging work or not. Can we apply dollar cost averaging? Okay, that means dollar cost averaging means you don't buy everything at one go. You buy by stages, or by different time, right? For example, like you want to commit a 1,000 ringgit investment every month. So every month you invest 1,000, 1,000, 1,000. It's like, the dollar cost averaging is how you apply normally when you buy unit trusts, right? Through a financial advisor or whatever. Because every month when you pay your premium, some of them actually go into investments, right? Or buying unit trusts. Okay, so that's dollar cost averaging. Is fixed every month. Not necessarily fixed, but every month you do it. Some month you pay more, but some month you pay less. But the idea is normally it's a fixed amount because you want to average the price out over time. Okay. Now, this will work well if your objective is purely dividends and not capital gains. Later, I will show you the examples. All right. To do this, it takes a lot of time, because you really need to do most of this manually, right? So to build that portfolio is not that simple. But once you get an idea, okay, then to get the data is not really a problem. Okay, so if it's only about dividends, then you don't care about capital gains, because you just want to keep on buying, whether the price goes up or goes down. As long as you get dividends, you are fine with it. All right, because remember, today's topic is about how you build passive income, right? Not maximize your profits or maximize your returns investment portfolio. This is a no-brainer, right? That means you just buy every month, and as long as the company makes money, the company is around, the company is good, you get dividends every year. All right. Some company pay dividends like every quarter, 4 times a year, some twice a year, some maybe just once a year. All right. So it depends. Okay. So of course, it works well also in stocks that pays dividend consistently. So that's why we have the 10-10-10 lease, right? The 10 years profits, 10 years dividends, and 10 years positive operating cash flow. Okay, so we need to know that they can also pay us when we buy the share. Into the future, they can also pay. Now, it also works best if the stock is not volatile. Okay, for example, like REITs and ETFs. I'll give you an example later. I'm going to compare these two in a short while. Okay, so let's say we want to pick out a stock first. Okay, this is where you need to do a Tesla, a back study, or a back test, all right, to see whether dollar cost averaging works. Because when you look at, or when you read the book, it makes sense. When you read, or when you just look at the idea, right, it makes sense. Okay, but I think dollar cost averaging will work if the price remains the same. Okay, for example, if you put your money into EPF, right, there is no price in EPF. Okay, but every year they give you dividends of between 4 to 6%, right? It doesn't matter. So there's no such thing as price. The price don't go up or go down. That's a fund. All right. So it makes sense. Okay, because price does not affect your dividends later. Okay, your dividends will just continue to go up as long as you put more money in. But if you invest in stocks or even in unit trust or other asset class, the only problem is this, right? Because price fluctuates, okay? But it's a double-edged sword, okay? If the company is good and the price fluctuate and go up and it keep on appreciates over time, then definitely your returns will be much bigger, all right? But if you pick the wrong stocks and the price depreciate over time, then of course, whatever returns that you get also is useless, right? Whatever dividends you get, because you have to pay back with your capital loss. Okay, so best is you can make money through your dividends and you can also make money with the capital gain. Okay. So I'm gonna put one counter here. So I'm gonna reveal this counter. Again, this is just for case study, right? So we have stock A over here, right? So every month, let's say I put the the date here. We start every end of the month. Maybe when you get salary, or the moment you get salary, let's say you invest 500 ringgit, okay, and you buy that particular counter. So the counter starts at 116. Now, if you can guess what counter is this, you can just put it down there. If you can guess before I reveal, all right. When I say stop, if you can guess, you can just type it down, okay. And the first person who answered this correctly, this counter, I'm gonna give you an equity striker t-shirt. All right, this t-shirt that I'm wearing. Okay, I know a lot of you been asking, but okay, so if you make the correct guess lah, just look at the price alone. So this is 2011. Okay, I'm gonna do a test for 11 years. All right, so that means every time I invest in 500 ringgit, 500 ringgit. Now, we can only buy shares in hundreds, right? So in this spreadsheet, okay, you see the shares, this column, this part over here. Let me just put a pointer. Okay, this is 431 shares. Now you cannot buy 431 shares, like you can only buy 400 shares. Okay, so you have to buy in lots. But here I'm assuming that you can actually buy one share just to make the calculation simpler, lah. All right, but of course, it is not really fully reflect the real figures. Okay, but this is just an example. Okay, so you put 500 ringgit every month. Okay, and on the right hand side here, you see these are the dividends that are being paid out. Okay, so for example, the first dividend here, let's say I started in January 2011, and July 31st they paid a 2 cents dividend, okay, per share. Then with the number of shares that I have, okay, I multiply by 0.02, I get 63 ringgit. So that's my first paycheck. All right, and then about a few months later, end of the year, I get another 100 ringgit and 16 dividend. Okay, and so on. All right. So, okay, the moment I see the first answer, I just say, all right lah. Okay, you guys can keep on guessing. Okay. Now, so what happens after that, right? After right now, so we're gonna take a look at the data up to end of June. All right, end of June. Okay. So now if you look at this, right? Because the stock actually went up from 116 to 220 in 20 months. All right, so your total invested in it 20 months, because you invest 500 ringgit every month, right? So it's 10,000 ringgit in total, but your asset value has gone up to 18,619, right? Because the share price has gone up from 116 and 220. But of course, if you buy everything at 116 and you sell at 220, your ROI or your returns is bigger. But because you did not buy at one price, right? You buy at different prices, so you average them out. Okay, so although you average them out, you buy low, you buy high, you are still able to achieve an 86% returns, which is not bad, right? Your asset value. So you put in 10,000 ringgit. Today, if I sell everything right now, okay, including the dividends that I collected, I have 18,600 ringgit. Okay. All right, guys, I think we already got an answer, and Mitra Chen is correct. Okay, this is basically Padini. Okay. So I'm just going to write it down so I don't forget. Mitra, we will message you later. All right. Please like our Facebook page, because if you don't like you don't like our Facebook page, then we cannot text you. All right. So we'll ask you what size and all that, and you can collect your t-shirts once it's ready lah. All right. So we'll get in touch with you, Mitra. Okay. Don't worry. After this, we got one more guess. Okay. You can guess one more stock. Now, so what happens if, let's say, you started in 31st of January 2011? That's 2011. What happens now, right? And we know the share price of Padini has gone up like all the way to 6 ringgit high. right? And this all adjusted price lah, right? 600 ringgit high, and it's now how much? And now it's trading only at about, let me see, I think it's got my, I will show you my spreadsheet later if you're, if there's time. Now it's only 2 ringgit and 50 cents, all right? This is up to end of June, 30th of June. Okay, 30th of June. So out of 30th of June, this is what you're going to get, okay? So now the current value is 88,780 ringgit, okay? The total investments that you have made is about 114 months, okay? It is 9.5 years lah, okay? 9.5 years. 57,000 ringgit. Your value today is 88,000. You have already collected 20,190 ringgit worth of dividends, all right? Which is basically half of your investments already, okay? But your total, okay, because what happened here is that whatever dividends that we collect, we reinvest back, we compound it, okay? We don't take the dividends. So that's why, this dividends here is included in the value of that share as well, okay? Whatever dividends that we have, we reinvest back again. All right, so 57,000 saving or investments, 88,000. So if you put your money in a bank every month, 500 ringgit, you get 57,000 ringgit, right? After 114 months, after 9.5 years. Okay, but if you bought Padini every month, if you just buy Padini every month without thinking, just every month you buy at the end of the month, you get 88,780 ringgits. Okay, of course, I did not add any interest on and this is excluding interest and also brokerage or commission fee lah. All right. Now, so at that point of time, when I look at the whole year dividend, right? So now even if you stop investing in this company, you will get a dividend of about 3,843 a year. Okay, 3,843. Of course, you think, oh, you after 10 years already still get 3,008, which is about how much a month, right? So 3,008 divided by 12, 300 ringgit a month. Okay, at least can pay for your internet and some other stuff lah. Okay, but of course this I'll later show you, right, why the price why your returns is only 56%, right? Because the value is only 88,000. You minus your investments, your savings, that's your profits. So you take your profits, divide by your capital, which is your savings, you get 56% returns, right? But if you look at the earliest stage when we bought, for example, in 2011, after 20 months, your returns is actually 86%. That's 20 months. How come 26%? But now it's only 56%. All right. Because if you notice, number one, okay, the share price has gone back to 2012 price, right? It's about 2 ringgit and 20 cents, right? And here this the figure that you see here, this is based on 2 ringgit and 40 cents, so almost the same price. Okay, the reason why it's lower is because remember you average them every month. So that means when the price is high at about 5 ringgit, 6 ringgit, you bought at that price also. All right, so you bought at a quite high price, and that's the reason why your returns are lower. Okay, because if you sell your share now, you still at least get 56% returns. Although I'll show you the share price of Padini in a short while. Although the price has gone up, maybe it was as high as 6 ringgit, in 2018, and then it went currently to a low of 240. All right, and of course it was lower before this. In March, is even lower after the when we had this lockdown. All right, now. But can we improve the returns? Okay, one of the problems in dollar cost averaging is, especially if you buy a volatile instrument asset class like stocks, for example, right? You end up buying high prices. Okay, especially in our market where where generally you can only buy, although you can short, right? But it's only intraday, so it doesn't really have a big impact on the long term, right? But generally prices go up, especially good companies. Okay, so now question is, can we improve the returns? What if I buy only when the prices are low? Okay, so there is a little bit of timing element in there. Okay, so how do you determine whether the price is low? Now there are many ways to do it lah. If you know about technical analysis or charting, you can use charts, right? Or you can use also fundamental ratios or financial ratios like PE or DY, right? price to earnings ratio or dividend yield. Okay, now for me, I would use dividend yield because, you know, for price to earnings ratio is a little bit, I mean, not really a bit, it's actually quite subjective. All right, um, because how do I know what's the real PE or good PE for that particular company? The best we can do is to compare with the industrial average, right? If the industrial average, let's say, is 10 price to earnings ratio, um, that means if the company has a PE of 20, that means their price is 2 times higher than the average of the industry. Okay, but it's also very difficult to compare that because that company may not be the same as, you know, maybe the business is a little bit different from that industry itself. Okay, so the closest or the best way for me, if you look at this, is basically dividend yields, because that's very close to that company, right? And dividend, you know, the company can only pay dividend if they make profits, right? So it's really up to the company. If they don't make profit, they cannot pay dividend. If they make very little profit, they pay little dividend. If they make a lot of profit, they pay more dividend. So it's up to that company's performance. All right. So what is dividend yield, right? So dividend yield is basically dividends per share divided by the share price. Okay, times 100 lah. You want to get a percentage, right? So basically, if share price goes up, assuming that dividend is the same, all right? Dividend is the same. So share price went up. If dividend is the same, then the yield comes down. Okay. So if the yield, if the share price come down, dividend remain the same. Share price come down, then the dividend yield goes up. Okay, like for example, right? Let's say the dividend is the same, right? 5 cents, 5 cents. The company be paying the 5 cents, 5 cents dividend. But if the share price is 1 ringgit, okay, your dividend yield is 5 cents over 1 ringgit times 100 is 5%. Okay, if the share price has gone up to 150, then your dividend yield is only 3.3%. So that means I can use dividend yield as a benchmark to tell me whether the price is high or low. Okay. So if I buy a share price right now and the dividend yield is 5%, and of course that the dividends that you receive is also based on the last dividend earnings lah, the last year's dividend earnings. All right. The question is whether they can pay future, whether they can pay the same or more into the future. That's where we have to analyze the company properly before we invest in. All right. The first step is, of course, that 10-10-10 list, right? The investment grade stock, to tell you whether the company has the ability to pay or not. Okay. So what happens if, let's say, so we have the I just expand the spreadsheet a little bit more. Okay. The dividend yield is on the right. What happens? What happens if I buy a share? I buy that particular share, let's say Padini right now. Since we are looking at Padini, right? That's the example that we're using. I will only buy Padini and buy that every month, 500 ringgit, right? Put 500 ringgit in if the dividend yield is 5% and above. Yeah, that means if it's 4%, I mean if below 5%, I will not invest. Right? Like here, for example, if you look at this, if it's like that particular price at 1 ringgit and 30 cents, the dividend yield is only 4.6%. At 1 ringgit and 9, the dividend yield is 5.5%. Okay, so that was okay. But when it comes to, let's say, this date here, okay, when the dividend yield has gone down to 4.6%, I'll not buy. Okay, I'll not buy. Until the yield becomes above 5% again, I start buying again. Okay. Okay, remember, because the yield higher, if the dividend is higher, you expect your returns on dividends to be higher as well. All right. If you buy when the dividend yield is low, that means you buy a very high price, then you expect your yield later to be lower as well. Okay. So what happens is this, I'll show you the results, right? So if you still, I'll show you later to compare. Okay. So what happens now? You see there's a difference. Okay. I'm going to put it down the previous one. If let's say the one at the bottom shows you that every month, regardless, you buy that share 500 ringgit every month. Okay. So at the end, your total investment is 57,000. Okay. And you calculate your returns here is 88,779. So your ROI is only 56%. Okay. Now, if I'm going to use that dividend yield, that means I'm going to buy only when dividend yields are above 5%. Okay, I'm going to invest only 19,500. That means a lot of the months I did not invest. Okay, only invest in the months where the dividend yield is above 5%. Okay, so the total dividends, of course, is lower because I buy lesser shares, right? If I buy all the shares, I got more dividends, but here I'm get 2,000 ringgit 85 dividends, but my investment is smaller, so my yield has actually gone up. Okay, from 6.7% to 10.7%. Okay, my ROI has also increased because my savings was 19,500 ringgit. My total investments 19,500, but the current stock value is 46,706. Okay, by just using a very simple timing method, which is, you know, by using dividend yield. Now, of course, you can improve further if you want to, lah, right? Okay. So, of course, now what happens to the months that I don't invest? Okay, why not you find another stock? Okay, why don't we find another stock to cover back? And okay, another thing, important thing is, so if you look at this, right, this Padini, they pay dividends. Okay, and they always pay in a, you can see the pattern one, like they always pay in March, June, September, and December, right? So you know that every March you're gonna get money, every June you're gonna get money, September you're gonna get money, December you're gonna get money. All right. But what if you want to build every month you get money? Okay. So I'm gonna give you another example. Okay, this is another example. So this is stock B. Okay. So if you guys wanna guess this, I'm gonna give you another T-shirt. Okay. I hope Alvin is not is okay with me giving out T-shirts today. Okay, if you can guess. So this is a bit harder, but if you can't guess, I give you some clues later on. All right. So now this is applying the same thing. From 2011 until now, you do the same thing. You buy 500 ringgit every month, right? Total is 57,000. It's the same like what we did for Padini, right? But this one has a slightly better returns, 96,180. So you see the ROI here, okay, is 68,000, 68.7%, as compared to Padini one earlier was 56%. Okay, so this one alone is 68.7%, right? Every month, just put in 500, 500, 500, 500. Okay, now you'll be receiving nearly 4,000 ringgit dividends a year. Okay, but your investments will total 57,000. That means your dividend yield that you're gonna get from your returns every year based on the 57,000 ringgit investment is 7% every year. All right. Now, what if I apply that strategy where we only buy this stock when the yield is more than 5%? All right. So this one has also increased. Okay. Instead of 57,000, now your total investment is only 38,000. All right. It is still higher than Padini one. Why? Because this stocks does not fluctuate that much. So that's your first clue. Okay. So if you know, you can guess lah the second one. Okay. DG Public Bank. Okay, let me just go through and see whether anyone got the answer already or not. Okay, we got a winner. Okay. Yes, the answer by Yo Ling Ling is correct. Okay, is Axis REIT. All right, Axis REIT. So I'm just gonna go on, right? So 38,000 ringgit savings. So Yo Ling Ling, we will contact you, all right, to ask your details later for the T-shirt. All right. So this one gives a dividend of 2,896 per year. Okay, now with second strategy, right? The yield is more than 5%, right? So your total investment is 38,000. So your yield has increased from 7% to 7.6%. Not much of a difference, right? As compared to Padini, the jump was huge. Okay, if you look at the ROI also has gone up a little bit. Not much difference from 68.7% to 76%. Still an increase, but not much. So now that tells me basically, right, that this particular counter does not fluctuate that much. Okay. Now this company pay dividends, or this REIT, right? Axis REIT pays February, May, August, December. And by the way, these two counters, Padini and Axis REITs, are Sharia compliant. All right. So so I'm going to compare. So the difference is not that much, okay? If as compared to Padini, okay? So what happens if, let's say, I bought Padini, I buy Padini and also buy Axis REIT in my portfolio, okay? Every month I still buy, but only when these two counters dividend yield is more than 5%. That means share price is not that high, right? More than 5%. So if the dividend yield is more than 5%, then I'll buy. That means the share price is low. Okay, so this is how I'm going to get, right? So the total is 57,500. So that means if you mix the two stocks together with the 5% dividend yield technique, right, or idea, it's only additional 500 ringgit shares, but it's basically like buying one, right? It's like buying every month. Okay, 57,000 ringgit. The value, if you combine both, is 112,000. Okay, that makes your ROI for both 96%. Okay, and if you combine both dividends, okay, based on the previous year total dividends, right, 1 year dividends, you get 4,951 ringgit dividends a year. Okay, a much bigger improvement than the earlier one. Okay, and because you combine the two, you get money almost every month, right? Because Axis REIT pay in different months, Padini pay in different months. So you get February, March, May, June, August, September, December is twice. All right. So basically, this is an idea, right? Now, of course, this is not the best ideal way to use, but this is basically like a no-brainer, right? And to get an 8.6% dividend yield, even when prices has fallen, all right? But the thing that Axis REIT has not fallen. In fact, Axis REIT has gone up to historical highs right now. Okay, but although it goes up at historical high, the price fluctuation is not as big, right? But Padini has come down quite significantly in the past 2 years. All right. So even that, okay, you can still make this kind of returns, okay, without even thinking anything. This is just a no-brainer thing. But of course, if you want to be more active, there are ways to make or to improve the returns for this. Okay, the more returns that you are able to improve, the more dividends you are able to get. All right, so we are moving closer, right? So let's say my objective is to get, let's say, just passive dividend every year, let's say 30,000 or 40,000 ringgit. How much should I be able to achieve? How much should I invest? Okay, here we are only looking at a 57,000 ringgit 500 investment. Okay, and 4,951 a year. It's basically nearly 10% every year you get from your investment. Okay, imagine if, let's say, this is 500,000, right? If it's 500,000, then it's going to be 49,500 a year. Okay, and in any investment, it's always better to put bigger initial capital when you start, right? So if you put a bigger capital when you start, because over the time when you compound it, it gets bigger. Because when you put in 500 every month, right, you're averaging it out. Okay, but then again, it depends, right? It depends on your capital. So you can, if really you can only invest in lower amount every month, then so be it, right? But if you have enough cash right now, you may want to invest first the most, and then every month you can still top up if you want to. All right, to build that dividend. I'm just gonna go on a little bit more before I show you the spreadsheet and how you can manipulate it. Now, so this is a comparison chart between the performance or the movements in Axis REIT and Padini, right? So if you look at this for the past 8 years, I only got able to get the data from 2013 until now. Okay, that range in Padini movement is 255% range. All right, and I'm talking about since the start in 2013. If you go back more than 2013, then is much higher, right? But let's say from 2013, and during the same period, Axis REIT, the movement in that 7-8 years is only 55%. So you can see the big difference, right? Stocks that are more volatile will affect your dividends, or you will affect your returns quite significantly. Okay, so dollar cost averaging is going to be good if you apply it on a very stable investment, stable price investment asset class. All right, like bonds or whatsoever, if you want to invest in bonds, right? Or some unit trusts which are stable, and so on. Okay, so it works very well. Okay, but for stock market, if you really want to gain the potential returns, then of course it will be better if you're able to be more active managing it, right? Is there a way to improve further? Definitely yes, right? So, but of course, you need to have more homework and you need to know more about how to analyze a good company. Okay, I'm just going to show you a very simple example. All right, this again is Padini, right? Padini. Okay, in 2017 to 2018. So you look at the, in 2017 itself, at that price, 3 ringgit. Okay, remember in 2011, 2012, the price was 1 ringgit and then it goes up 2 ringgit and now it's already 3 ringgit in 2017. The dividend yield was 3.8%. Their dividends is very consistent. Every time is about the same price, the same dividend that they pay. All right, the same dividend that they pay. So 3.8%. And now the thing is, you can already see, right? The price has gone up from 3 ringgit to 6 ringgit, doubled. And you can see your dividend yield has gone up from 3.8% to 1.9%. Gone down significantly, right? Okay. And at that point of time, your returns, okay, the total returns when the price was about 590 to 6 ringgit was 183,000. So if you exit on that day, all right, on the 31st of August 2018, for example, because the yield has gone down so low, I might, this is where you can also start to shift to other counters, right? Maybe the yield after, if it goes below 3%, it's already an indication that, you know what, because 3% is almost like an FD, right? I might as well just put money in FD, isn't it? But of course, FD, you don't grow. We are the reason why we buy Padini is because we expect the price to go up higher and the company to do well and the price continue to go up higher. All right. But this has gone down to ridiculously low levels, right? 2%, 1.9%. That means it tells me, but the dividends are the same, right? But the price has gone up significantly. Okay, or maybe if you look at the financials for the company, you see that the growth is in the profits may not be as much as the growth in price stock. We call it a divergence. Okay, so when we see all this happening, it's probably time to maybe move out from this counter and find another counter that provides better value. All right. So that's why we learn about investing, right? So that we know whether the company is, whether the price that we are buying right now it's below its value. Okay, for example, now on the 18th of or let's say in the whole year of 2018, I know that if I'm gonna buy Padini now, I'm not gonna buy at below value anymore. All right, because the yield is so low. Okay, so if I see this pattern right here, I may want to start change. So if you can monitor this just by looking at the dividend yield alone, you can already find that pattern. Okay. um so if you exit here, okay, if you exit here, let's say 183,000, your total investment until that point after 92 months was 46,000, your return would have been 298%. Okay, in 92 months, which is about 7 years. Okay, 7 years, 292%. But if you keep holding until today, right? Remember this one here? You keep holding today, the value you see from 183,000 because the share price fell from 6 ringgit to 2 ringgit plus, from 183,000 become only 88,000. Okay, which gives you, instead of a 300% returns, you only get 56% returns. Okay. So you can actually start to build a portfolio first. Very simple right now. Just look at the dividend yield indicator, right? If you want to, okay. But yeah, you can only apply this. Remember on that, probably the list that you are downloading right now, because these are stocks that gives you the consistency. That's what we want. All right. Now, what makes Sharia compliant ethical is because if you look, okay, this is also on the first video, on the first webinar that we did. Okay, we already mentioned about what is Sharia investing all about, right? So if you look at it, although it's is based on a religious, based on the Muslim principles, right? But if you look at it, is on ethics wise, it also makes a lot of sense. All right. So you can go through this, and again, if you want to go more details, you go and look at the first recording, which is 2 weeks ago. All right. Okay, guys, that ends my presentation. So I only got like 5 more minutes or 6 minutes or 10 minutes to answer your questions. Maybe I can go up to 10 minutes, no problem. All right. This is Bursa-𝑖. So you want to get more information on Bursa-𝑖, just go to their social media pages over here, right? ICM at Bursa in Twitter, ICM_Bursa on Instagram. Okay, just Islamic Capital Market Bursa Malaysia on Facebook, and ICM at Bursa for email. Right. So if you need to contact them, if you need to reach them, you can also ask them or reach them through this social media. All right. Okay, lastly, before I answer your questions, if you want to download the slides today, please go to this website, bit.ly/Bursa Sharia. Okay, once you have completed the evaluation form, it will take a few days or maybe 1 week later. We will try to get it as soon as possible, but it will take a few days before you get the slides, because we want to give you guys time to go and fill out all the form first, and then only we'll start to send the slides to you. All right, so come here, bit.ly/Bursa Sharia to download the slides. All right. Okay, so now I'm going to go to Q&A. So if you guys have any questions and or questions, not question and answer, if you guys have any questions, you can ask right now. I see there are no questions, and I hope my either you got the idea, or you don't understand at all. All right. Okay, so I was because you guys have been very quiet. So if you guys got it, if you guys think that today is useful, say yes. All right. If it's not useful, don't say no. Just keep quiet. Okay. Right, so guys, we are talking about sensible investment, right? We are talking about investing in the markets. Like Alvin is asking, right? People want fast money and so on. Yes, you can go and make the fast money if you want. If you do not know what you're doing, if you're not serious enough, basically most of the people will start losing money anyways. All right. So investing is totally different, right? People say they play market, you don't play stock market, but you invest in stock market. And in order to invest, and be profitable or be a good investor, you need to be a well-informed investor, right? So that's the reason why we are giving this investment education series, especially Bursa-𝐼 and also Bursa Malaysia is giving this so that you guys can actually learn to be a well-informed investor, right? Okay, thank you so much. I thought you guys are quiet, or whether you understand me or you don't. Okay. Brandon, you talk about how about Bursa? So I haven't done the test on Bursa. You just try that. If you got the data, you do a back test, because even in these two counters, Padini and Axis Read, I have to do this manually, right? And I have to, even in the 10 years data, I need a few years of data. I need a few hours to actually got the data that we have today. All right, so if there are no questions, okay, make sure you go deeper, or make sure you get this idea. I know, of course, this is good. It will be actually quite good if you are able to build this, especially if you do really want to do dollar cost averaging. All right, on ETFs or REITs. I want to say ETF. ETFs quite fluctuated. It has some fluctuation because it depends on the ETF, right? If the ETF is mostly on the stock market, then you get that fluctuation. But REITs are pretty much stable. All right. In the coming webinars, we're going to talk about ETFs and REITs. All right. So of course, we're going to talk about Shariah-compliant ETFs and REITs. So do continue to join us. And what I'm going to do next week as well is that you have that 10. I'm sure some of you already downloaded. That investment grade stocks list. Next week I'm going to give you another list. All right. And so what's that list about? That list is the same list that you receive now. All right, that I'm going to share with you now, but I'm going to put in dividend yield. All right, so I'm gonna filter out stocks where dividend yield is above 6%. Okay, remember the strategy that I showed you earlier, right? If I want to do this better than the dollar cost averaging, I will only buy that particular share if the dividend yield is more than 5%. So the list I'm going to share with you are all more than 6%. All right, so for you to work out with lah. So at least when you want to start to build that portfolio, or when you want to start to do research, use that list. All right, because that list provide consistency. Don't go and choose other stocks, right? Don't choose other speculative stocks and all that. It will not work. Okay, you use the list of stocks that we're going to give you or you're going to download, right? And that's where you work with. Okay, so just work around that list and you should be safe lah. Okay, by using dollar cost averaging. And remember, dollar cost averaging, or if you average them out, it will only see results in the long term. All right, at least 5 years, 10 years, you can see results. If you expect to see even returns for a year, 1 year, then sorry lah. Okay, but unless if in the next 1 year the stock market is going to be very bullish, then you can see returns. Okay, so but it will only work over the years. All right, so do join us next week. Again, I'll give you the link for the 6% dividend yield and above only next week, so you have to join me next week. Okay, all right, let me see if you have any questions before we go on. You're focusing on, okay, well done, Daniel. So that's the good thing about the webinar, because even if you can't take some of it, you can go back, you can go back and review the video again. Melissa Lim, can we use the 5% risk? Yes, 5% rule. I mean, it's like, if the dividend yield is 5%, means what? That means if you buy the share right now, right, you get a 5% dividend, all right? But assuming that they're going to pay the same dividend the next year also, right? That's why consistency is important. Okay, so you want to get higher returns, higher than 5%. Of course, if you want to put higher, even higher returns and buy lesser, only when the price is really low, you can put 7-8%, right? But so when I give you the list, you can actually see the percentage lah. Okay, if you put 8% and above, you only get a handful of stock, right? But you get a lot of stocks actually in March, early March. There are plenty of them, because a lot of them the share prices were low. Okay, so 5% is good lah. It's like you want to buy a investment right now. If people tell you, hey, 5%, okay or not? Oh, okay lah, 5%, not bad, right? At least it's better than FDs, right? And maybe it's better than EPF. Okay, but of course not. If someone promises you 10% a month, 12% a month, 20% a month, then you can ask them to go and fly kite lah, right? Because if it's too good to be true, then it probably is, right? So, guys, thank you very much for joining us. I hope that it's been a very good educational educational webinar today. And again, this is brought to you by Bursa Malaysia-𝑖. And for those Muslims especially, you can apply the investments. Of course, you must have an investment plan first. You're going to have a series of another 4 more coming up, right? And just look for Sharia compliance companies to invest in. All right. Banks are mostly not Sharia compliant. Yes. Okay. So thank you very much, and we'll see you again next week for Bursa-𝑖. In fact, for those who are still new with us, we have every night we have an event, so you can just continue to come, and we have different topics for different events. You can just look at our events page or our post to see what topics they are. All right. So good night, everybody, and all the best to you.